in the previous segment, Florian, but we were just having a chat during the ad break, us three, and you were saying you'd really like to highlight something which is quite eye-popping as far as a data set goes, and that is the amount of money that households are sitting on. Savings. It's 140 trillion RMB, and I'm not smart enough to do the math into US dollars on the spot, but let's just say it's a lot of money and it needs to be pushed down into the economy. How?
Yeah, so I think first, back on the number, you're absolutely right. It's about 140 trillion with a T of RMB. And in these days of monetary easing around the world, trillions, billions, millions is all the same. But 140 trillion RMB is in round numbers just under 20 trillion US dollars. We're talking more than 100% of GDP. That's a tremendous number. And just to put the number in sort of broader context, you just need probably 20 to 30% of that number to buy the free float of the entire Shanghai and Hong Kong Stock Exchange. So we are, the number is truly staggering. And the reason I make that somewhat speculative comparison is to highlight that that money so far is sitting in low-yielding bank deposits. So when we're talking household deposits at banks of 140 trillion, what we're really saying is 140 trillion of household wealth is earning measly interest rates. As we all know, inflation in China is low and interest rates in China are low. And one should never make predictions, and particularly on air, but interest rates in China are likely to stay low for a while. That money is really not earning a return for Chinese households. Now, why is it there? It's certainly a reflection of risk aversion in the face of the pandemic, in the face of the famous wealth management products, the WMPs, not delivering a return or creating losses for people. So people have divested from WMPs. People, as we also know, are not investing in property as much as they used to. They still do, by the way. I think what's a bit missing in the conversation is China is still selling about 1 billion or so square meters every year of property. So people still buy their first house. They don't buy the second, third, and fourth anymore. And that money is now sitting in bank accounts, and it's doing nothing for now. And Chinese households have indicated that one of the things that they are interested in some of the household surveys we track, for example, China Realty Research early this summer was highlighting that households are contemplating gold and equities, and also more deposits, expressing the continued risk aversion, of course.
Let me jump in, Florian. I'm just wondering, with so much money sitting in the bank accounts, how much of that Chinese deposits, trillions, as you say, are coming out of China and buying assets in other countries in Asia? For instance, Singapore, property, for instance. I mean, in Singapore, we've seen the property go up substantially because foreign investors are coming in a big way. How much of that Chinese money is coming out of China into the rest of Asia?
Well, at the moment, a lot of it seems to be staying on the balance sheets of the banks, as the number tells you, right? So that those 140 trillion are inside the perimeter of China. It's been harder and harder to track the China capital account data. There's been a lot of discrepancies between the customs data, the central bank data, safe data. But what's been interesting to observe is that China seems to have been quite comfortable, actually, with a little bit of money leaving, despite the exchange rate pressures. If you look at, for example, the southbound Connect data, where Chinese investors have been buying Hong Kong stocks through the southbound Connect, even though at the same time the Connect in the other direction actually had outflows, i.e. foreigners were dumping A shares through the northbound Connect. So a little bit of capital outflow seems to be tolerated even at a time when China is willing, is actually really managing its exchange rate very strongly, as we saw in the